friends, welcome to Adda 24/7. Today we are in a CAIIB central banking session and main topic for today is RBI's role as a monetary policy maker. Means what is monetary policy, how does it affect the economy, what is RBI's role, what are the various tools which used by RBI. We'll be studying that, and plus we'll be studying the objective questions on all other parts also, not only this topic. Objective questions will be combined. Okay, so it's a very educative session for you all, so definitely follow it till the end, because central banking is an important, one of the important and the toughest elective in CAIIB. So let's start. Firstly, evolution of monetary policy framework in India. So framework, how did this monetary policy actually come up? So, and what were the reasons for this? In order to attain the objectives of monetary policy, it is necessary to have consistent policy framework. See, this consistent means what? Understand the meaning of this word consistent. It doesn't mean that today RBI increases the repo rate after 2 months here. Firstly, understand. In a year, RBI can bring monetary policy any number of times. Remember, RBI can bring monetary policy any number of times. Any number of times. Okay. Presently, what does it do? Presently, it brings every 2 months. Right now, RBI is bringing every 2 months this monetary policy, roughly. It's not that every exactly after 2 months. Sometimes they will be somewhat higher, somewhat lower. Okay. So what do they do in this monetary policy? They take, basically remember, monetary policies framework or monetary policy structure is designed for short term. Always remember, short term. It never thinks of monetary policy, never thinks of 10 years, 15 years, nothing. Short term, every 2 months it comes. And basic purpose of monetary policy is liquidity. Liquidity management. Liquidity is what? Here, liquidity is a short term tool, actually remember. Liquidity is here. Always remember, there are two types of funding, as we have in the banking also. Here, in banking what happens? We have cash credit and we have term loan. Similar to that, I'll explain you according to that only. That becomes easier. Cash credit, right? And second is what? Term loan, TL. Term loan. Okay. Now tell me, for short term, which loan is always applicable? CC or term loan? Always CC. Short term. CC is always a short term instrument. Means below 1 year. And this is long term. Same logic applies over here. Monetary policy is for monetary. That is for short term. And long term, then what is the long term policy? That is a long term RBI's framework. There we have bonds. Here we have T-bills. T-bills. There we have bonds. Dated bonds we call it. Dated bonds. There we have dated bonds. So understand the difference first. And the purpose of monetary policy. Monetary policy is never ever for long term. It is always to maintain the short term interest rates in proper condition. Okay. Broadly, monetary policy framework consists of objectives, operating procedure and governance arrangements. Right. So objectives, what are the objectives of monetary policy? To maintain the important part. I'll give you one important. To maintain the inflation in control. See here. The main job of RBI's monetary policy is only one, that is maintain the inflation in control. Remaining everything are secondary. Primary role is this. Operating procedure means how does it operate? What are the tools it uses? Governance means basically the transparency. How transparent is RBI? Remember, in India, RBI has to be completely transparent except those secret decisions. Secret means which are not required as such by the common public and which can be harmful if known to others. Only except those, everything is transparent. Governance means communication, free communication, transparency. Operating procedure means various tools. What are the tools which RBI uses? RBI uses T-bills, treasury bills. Plus it uses various other tools. Here, T-bills is just an instrument of transfer. Important is OMO, LAF, Liquidity Adjustment Facility, MSF. All these tools are used by RBI. Repo, reverse repo. Okay. Objectives are the aims of the monetary policy, which are goal variables or nominal anchors, and long-term in scope, but not directly under the control of RBI. Now understand this. Long-term, the point over here is which are goal variables. Goal variables means control the inflation, and nominal anchors. Long-term in scope. Long-term in scope means, see here, what did I say just now? Monetary policy is for short-term, is a short-term instrument. But why is it mentioned over here long-term in scope? Because it means if I maintain the short-term inflation in control over regular periods, then only it will give me a long-term goal. If RBI is able to maintain the inflation in control for every 2 months, and this goes on for next 10 years, so automatically it becomes long-term, isn't it? But not directly under the control of RBI. See, not directly means what? To maintain the objectives. Inflation control is a job of RBI. Controls here. It's not that totally means if something goes wrong. For example, in UK, presently, check right now in UK what is happening. The inflation rates are too high. Now they are cooling down. Similarly in US, the inflation rates were too high. Now these are developed countries. Then also they had this problem. So why? Because it happened due to those situations, like that main reason was that Russia-Ukraine war. It happened due to those reasons which are not in the control of their central bank. Similarly, RBI over here, everything will not be under the control. RBI tries to maintain as good position or as better position, golden handshake between the existing situations. As a result, central bank strives to achieve these objectives only indirectly by targeting intermediate and operating targets, right? What does it mean? See, the main reason for inflation, let's say right now is Russia-Ukraine war. Let's say this is the reason. Is RBI able to interfere in that Russia-Ukraine war in any way? Not possible, right? What will it do? It will try to control that inflation indirectly, because it can't stop that. If Russia says, I want to wage a war against Ukraine, nobody can stop it. So it will try to indirectly control it by targeting the intermediate and operating targets, means which are in the hands of RBI. What are in the hands of RBI? Increasing the rates. If the inflation goes out of control, RBI will increase the rates. If the inflation is too low, then RBI will decrease the rates. Both the things are harmful. Too high inflation is harmful and too low inflation is also harmful. Always remember, okay? Which bear a stable relationship with the ultimate objective. See this, stable relationship. So if RBI, that's what I said. If RBI is able to control the short-term inflations, this 2 months controlled, this 2 months controlled, this 2 months controlled. So long-term it becomes very easy. So it is in stable relationship with the ultimate objectives of controlling the inflation. Before going ahead, everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, everything. Whatever you need for clearing your JIB and CIB, you'll get it over here. So that's why immediately download it. Okay. From the perspective of the global best practices, historically, bank reserves and short-term interest rates have evolved as a dominant operating target, two dominant operating targets. So, two dominant operating targets. What are these? Bank reserves and short-term interest. What are these bank reserves? What is the short-term interest? Let me write it here. Bank reserve means here comes the role of main role reserves, the main role of SLR and CRR. These are the two main bank reserves. Cash reserve ratio, statutory liquidity ratio. So these are the part of bank reserves. Short-term interest rate, short-term interest. So that means what? This is basically repo. Mainly repo. Okay, repo and reverse repo. Obviously, when we say repo, it means reverse repo is included in this. Okay, so repo and reverse repo. Now, what is repo? What is reverse repo? How many of you can tell me? Just type in the comment section. Repo means, I'll ask you a specific question. When RBI lends to the banks, RBI gives loans to the banks. it gives it through what? Does it give through repo or does it give through reverse repo? When RBI gives loans to the banks, it gives through what? Repo or reverse repo? Yes, it is repo. Very good. It is through repo. So RBI lends here. RBI lends. Okay. And reverse repo, here RBI takes money. Means RBI sucks the money, you can call it. RBI sucks the money. Takes the money out of the system through reverse repo. Okay. So from the perspective of global practices, bank reserves and short-term interest rates have evolved as the two dominant operating targets. Means what? Suppose if the inflation is too high, let me write it over here. Inflation, if it is too high, what will RBI do? To control this inflation, RBI will go take the step of increasing the repo rates. Increase what? All the rates. Repo also, CRR also, not reverse repo. Okay, repo also and CRR also. So increase repo and CRR. Because of this, what happens? CRR, right? So if repo and CRR are increased, automatically the loan rates increase. Loan rates will go up. If loan rates will go up, people will buy less money from the bank. Will take lesser loans from the banks. So once the lesser loans go out of the bank, the cash in the pockets of common person is reduced. Because of that, inflation automatically comes down. So that's why this is a prime tool used by RBI while controlling the inflation in any country, not only India, any country. I am not talking of only RBI. RBI is for India. You can call it a central bank. Any central bank uses the same tools, repo and CR. Inflation going up, the central bank will increase the repo and CRR. If inflation is going too low, below the acceptable levels, so at that time RBI will reduce this repo and CRR. Okay. India's monetary policy framework has undergone several transformations, reflecting underlying macroeconomic and financial conditions. During 1971 to 1985, the monetization of fiscal deficit exerted a dominant influence on the conduct of the monetary policy. Now, what do you mean by this? Firstly, understand this framework has undergone several transformations reflecting underlying macroeconomic and financial conditions. So that is okay. That is a simple sentence. Undergone transformation. Now, what about this? During 1971 to 1985, monetization of fiscal deficit. This is a very important part. Fiscal deficit means what? What is fiscal deficit? Fiscal deficit means government's expenses. See this. Government, this is government. So government will have expenses and it will have income, right? Expense and income. What will be the income source of government? There are two to three major sources of income. One is capital income, second is revenue income. Capital means what? See this, capital income, capital, okay, and second is revenue. What is capital income over here? Capital means selling of the assets, Navratnas, PSUs, public sector banks, public sector units, land holdings. Government will go on selling it. So that is capital. It is done once. It's not done every time. Okay. Then that is one part. And second capital earning source is what? Taking loans from various institutions, various other countries. That is also a capital income source. Because after all, the money will come from that loan, from IMF, from World Bank, anywhere government can take. So that is capital. What about revenue? Revenue means basically tax, regular income, daily bread and butter. So what is the bread and butter of government? Tax. So tax can be of various forms, direct and indirect. Direct means which is the direct tax which we pay in income tax. Indirect means GST, which we pay indirectly, unknowingly. So these are the incomes. Now what about the expenses? Expenses can be various expenses, planned and unplanned we call it, right? Planned expense, unplanned expense. Planned means what? Everything which government knows as per the budget. Where does the planned in expense come from? Here, what is government's budget? Every year government gives the budget in roughly February, March. So whenever government gives this budget, what does it do? It just gives you the balance sheet of it and what is the projection for the future 1 year. So that will show what is the income and what is the expense of that government in the last year. So if that expense is more as compared to the income, look at this. If expenses, I'll write it over here. If this expense is more than the income, then it becomes a deficit. So where will this government bring the money from? Suppose the expense is rupees 100, income is only rupees 80. Where will this 20 rupees come from? This 20 rupees will come either from taking loans from somebody, means again this capital will have to be increased, right? Loans will have to be increased. Or second option is, which is mentioned over here. What did RBI do? RBI used to print the money in between. Suppose there is a gap of 20 rupees. So RBI used to print the notes of 20 rupees. Notes means amounting to 20 rupees. I am saying, suppose if this is 1 lakh and this is 80,000. Expense is 1 lakh, income is 80,000. Then the gap will be 20,000. So what will RBI do? RBI will print the cash of 20,000. Print actual money of 20,000. So that cash will fill up this gap because now there is a money in the system. So this is known as monetization of fiscal deficit. This is very wrong method, printing the money. It's of no logic. So that's why that is gone now. Nowadays, none of the central banks try to use this printing except USA. USA goes on printing up till even today. Because that currency is distributed throughout the world. That is considered as a base currency. That's why they are able to do this. The day this world stops using dollar as a base currency, they will also go. Okay, so coming back, the monetization of fiscal deficit exerted dominant influence on the conduct of the monetary policy. Okay, so because of this financing of these fiscal deficit of the government, RBI was under huge pressure. Against this backdrop, the committee to review the working of monetary system, Chairman Dr. Sukhomai Chakravarti, recommended in 1985 a new monetary policy framework based on the monetary targeting. Monetary targeting means it must focus strictly on the clear objectives. It shouldn't be just the financing bank for the government. It should focus on its own targets of inflation. See here, whenever new money is printed, it will help the government. But what about this new money? This new money which comes in the system, it increases the inflation. So that is bad for the common public. Even the government's balance sheet is balanced at that time. But that is bad for the government. So that's why this committee gave the recommendation that nothing doing like this. Target the monetary targeting means target the inflation. What the job you have. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel you will be getting number 1 free YouTube series on all the subjects. Okay, all the subjects of JIB and CIB, all of them. Plus what you will be getting next? You will be getting number 2 the latest updates from IIBF on JIB and CIB. Latest, all of them. Immediately you get it. So that's why whatever is free, grab it fast, isn't it? Always, we should always believe in life. Whatever is free, we must grab it first. Click on that bell icon, click on that subscription button. That's it, isn't it? Monetary targeting framework. What did I say just now? See, this committee gave what? It gave monetary targeting. See here, framework based on monetary targeting. But what was that? What is actually monetary targeting? See this. Under this framework, broad money became the intermediate target, while reserve money was one of the main operating instruments for achieving the control on the broad money growth. Now, what is all this? Many of you might not be knowing this because what happens in your earlier portion of CIB, before your new portion, you had this topic of broad money, reserve money, then you had this narrow money. So all these were there, but this time they have removed it. So that's why in your ABM you had it, but now that ABM, that topic is gone. So that's why many of you even don't know what is this. So I'll give you the details. See this, reserve money. Okay, reserve money means name itself says reserve. So it means amount with the Reserve Bank. While the reserve money was one of the main operating instruments, the amount which RBI had, the cash which RBI had, so it includes all the other parts also. Cash means not only cash, cash and cash equivalents mean the T-bills. Treasury bills are also called as cash equivalents. M1, that is CASA from the bank. This is called as narrow money. Okay. M1 is basically CASA of the bank, current account, savings account. M2, M2 means M1 plus post savings account. M2 is M1 plus post savings account. Okay, whatever is there in the post also has the same savings account, right? M3 is broad money, but this broad money is not related to M2. M3 is simply M1 plus FD of the banks, FD, term deposits. So keep this very simple. I have written it in a simple manner. Okay, so M3 is basically M1 plus FD. Now there is M4 also. M4 means M3 plus other deposits of post office, other deposits. Post office also has other deposits. So those of post. So those are considered under M4. But excuse me, if M4 is hardly used anywhere. Everywhere main money used is M0, M1, M2 and not even M2. Main is M0, M1 and M3. These three monies are always used throughout the banking system. RBI decides its policies on M0, M1 and M3. Okay, there is a ratio. Okay, means the ratio of reserve money to broad money. You will have this separately in the paid classes. Okay, when we take the central banking paid classes, we will be having that. So under this framework, broad money became the intermediate target, while reserve money was one of the main operating instruments for achieving the control. Means RBI mainly focuses on reserve money. Okay. Accordingly, monetary means M3 projections was made consistent with the expected real GDP and a tolerable level of inflation. Means whenever we have broad money means CASA of the bank plus FD. So this will basically result in CRR somewhere. If CRR is controlled, everything will be controlled over here. So why is CRR controlled? CRR is controlled because to maintain the inflation. Similarly, loans also. Suppose if repo is controlled, automatically this FD rate changes. If I increase the repo rate, automatically somewhere it is linked and FD rate automatically increases. Because there is a pressure on the banks. Reverse pressure is also there. If repo is decreased, it comes to reverse pressure and FD rate goes down. So that's why broad money over here is the intermediate target. Okay, means this projections was made consistent so that while controlling the broad money, the second leg of this or the second in that suppose if I draw this weighing scale tarazu, in that weighing scale one side there is the broad money and other side there is inflation. It has to be balanced. Okay. Now let's come to the question system. Okay. Now it is your time now. I'll ask the questions and of course I'll answer them. It's not that I won't answer them. So these are from the book, from your books actually. So that's why once I say these are from the books, they have high possibility of coming in the exam. The Committee on Capital Account Convertibility was chaired by the following expert on the central banking. So Capital Account Convertibility, the committee on this was chaired by whom? C. Rangarajan, S.S. Tarapur, Y.V. Reddy and Bimal Jalan. So it is who? Just check it. Check it. You can Google it. Give me the answer in the comment section. Yes. Is it Rangarajan? Is it Tarapur, Reddy or Jalan? Who was chairing this committee? Yes. While giving your banking exams, okay. At that time also you might have come across this question. So who chaired this? It was chaired by S.S. Tarapur. Okay, S.S. Tarapur committee was the committee which gave the major rulings on capital account convertibility. Okay, what is capital account convertibility? What do you mean by this? Here, remember one thing. In India, there are two accounts. Okay, one is current account and second is capital account. Okay, capital capital account and current account, or you can call it balance of payment and balance of trade. This is mainly balance of payment, and this is basically BOT many a times. Largely I will call it. Largely it is BOT. So rupee is fully convertible under balance of trade. Convertible. Rupee is fully convertible under BOT, but under this it is partially convertible. So this, earlier it was not there. Earlier even here there was partial convertibility, and it was in fact not even partial, it was restricted convertibility. Rupee was not allowed to be converted. Now in capital accounts you can freely convert it. Why? Suppose if I am having some import order or export order, okay, I am having the export order of, let's say, 10 crore USD. 10 crore USD. So what does it mean? Can't I take that order? I can. If I get those 10 crore dollars from US, can't I convert them into rupees? I can. Nobody can stop me as far as I have the legal documents for this. If I don't have the legal document, then I'm doing some hawala transaction. It's that simple, isn't it? So this SS Tarapur Committee on Capital Account Convertibility gave this concept of fully convertibility of rupee. Pick up the following, one of the major preconditions of capital account convertibility as laid down by the committee on CSC. So what were the conditions which they had kept in mind? Okay, adequate foreign exchange reserves to achieve minimal annual growth rate, exchange rate stability, and mandated inflation target. What was the right answer? What do you think should be the right answer over here? Now, many of us feel that it is what? Foreign exchange. Here, capital account convertibility, just now I spoke. So, everyone amongst you might feel that it is related to foreign exchange reserves, because to adequate reserves, so that will be main target, or minimal annual growth rate. But many of us feel this is the right answer, A, or C also, exchange rate stability. The dollar and rupee should be stable. We apply our own logics, but that is not the right answer. None of these is the right answer. The right answer is this, mandated inflation target. Always remember this. The primary role of RBI is inflation. This forex reserves, everything comes secondary. Even forex reserves are targeted for maintaining the inflation. Understand this. Why does RBI check the forex reserves regularly? It's not that it's just concerned about the dollar rupee convertibility, it's concerned about inflation. If the forex reserves are low, now I'll give you an example. See this. Check Pakistan, what is happening. Pakistan or Sri Lanka also. Neighbors, right? Sri Lanka. Just check out on the Google. What are the forex reserves they are having? What are the forex reserves they are having? Just check out on Google. How many days forex reserve they do have? How many days? So they have for hardly 15 days now. 15 days forex reserves. Similarly, Sri Lanka, 15-20 days. How many days India has? See here, the World Bank says that any country to be stable, it must have the forex reserve so that it can import the necessary goods, mainly oil. It can import the necessary goods for next 9 months. For next 9 months. If any country has forex reserves which are for the next 9 months, means it can import regularly without giving any problem. Then the country is stable. And then the inflation is also stable. India presently has more than 12 months. More than. Keeping too much is also bad. Suppose you'll say that why don't we keep it for 2 years? That is also bad, because after all it's a current account. It won't give me any money, isn't it? So why to keep my money in current account? So always remember, forex reserves are directly related with inflation. What is the inflation rate in Pakistan and Sri Lanka? Check it now. Just type on Google now. What is the inflation rate? Pakistan, Sri Lanka, too high. Why too high? Because no forex reserves. They can't. All the developing countries are mainly dependent on these forex reserves for buying this, importing the goods, mainly energy. So that's why mandated inflation target is a prime objective of RBI. During the macroeconomic crisis in 1991, inflation on the annualized basis reached a peak of, means at the 1991 when we opened up the economy. At that time, inflation was what rate? 15, 17, 20, 30%? Yes. Inflation was, at that time, it was how much? How much? Just check out on Google if you can. It was 17% at that time. 17% inflation. It was too huge at that time. Okay. So 17% is the right answer over here. Okay. Next one. By the way, have you all liked and subscribed to the channel? Everyone do it fast. We'll wait for some time if you want. Subscribe to this channel immediately. Click on the bell icon. Everyone, do it fast. Click on the bell icon. The Discount and Finance House of India was established following the recommendations of the following committee. Now, what is this DF, Discount and Finance House of India? That we'll see in the classes when we start, okay, because it's a big topic. So this DFHD was established in India on the recommendation of whom? So it was a recommendation of banking sector reforms, financial sector reforms, Committee on Monetary Reforms and Committee on External Reform. So who had given this? Yeah, you can call this DFHI. Okay, DFHI, Discount and Finance House of India, DFHI. Who had given this recommendation? The committee, it was given by, yes, how many of you can answer? Who had given this? It was given by, yeah, it was given by this Monetary Policy, Committee on Monetary Reform. Okay, this is the answer. But what is the role of this? What is the DFHI actually? What does it do? We are just saying the name, telling the name. I'll give in details when the class comes. The prime objective of DFHI is to facilitate the smoothing of the short-term liquidity imbalance. Remember this, smoothing of the short-term liquidity imbalances. Now this is similar to that RBI's credit and monetary policy. See, all these things are targeting short-term only. Credit and monetary policy of RBI, then this DFHI, then these tools of T-bills, okay, cash bills, CMBs we call it. So all these are for short-term liquidity. So that is the basic role of DFHI. Okay. Next one. Some of the objectives of setting up NHB, National Housing Bank, are given below. Choose the best option. Promote sound, healthy, viable and cost-effective housing finance system. Promote network of dedicated housing finance institutions. To leverage the degree of completion in the housing industry and both A and B. What is the answer for this? NHB, National Housing Bank. What is the role of National Housing Bank? Is it to leverage the degree of completion in the housing industry? Means what is this? Housing industry means, suppose if Hiranandani tomorrow or any other Godrej properties, they are building some property or they are building some housing sector, okay, some scheme they are building. Will this NHB look into it that it will go and check, your project is completed up to what stage? NHB doesn't do all these things. It is the bank. Let's think about yourself only. When you are in the bank, do you go and check every builder's completion stage? No. Whenever we give the home loan, our job is to promote this a sound, healthy, viable, cost-effective housing finance system. That is number one. And see to it that the network of these dedicated housing finance institutions are increased. The more these housing finance institutions are there, the smooth will be the flow of the system into the in the hands of the public, right? So that is important. Both these jobs are important to be done by this NHB. So the answer is D, all of the above. Okay. The India Office Committee's report recommended the setting of Reserve Bank of India as, now these are other questions as such. So why was this Reserve Bank of India set up as such? So recommended this what? On the basis of what? Of as a shareholders bank or public sector bank or this what public bank with public and private participation, bank with dominant government participation. So what is the answer? Yeah. It was here. It was in long back. IOC 1933. Look at this. 1933 IOC came. Then in 1934 RBI Act came. And then in 1935 RBI came actually in existence. So this IOC recommended it as a shareholders bank. Reserve Bank was a shareholders bank actually. The preemption of credit for priority sectors like agriculture was notable feature of the banking development in India. Means the preemption of credit for priority sectors. Priority means what? Preemption means what? Giving the credit to these priority sectors. Like agriculture was a notable feature. Means when did it come in picture? Earlier, after this freedom of India, at that time, loan was not given to these agri and primary sectors or these priority sectors. When did it come? Since the inception of RBI, post nationalization period. Since the inception of the bank and in 1960s. So when did it start? Everyone. Now this is a common question as such. You can definitely answer this. It was in everyone. It was in correct post nationalization period. Okay. Post nationalization period. So after nationalization, the lending to the priority sector started. Why should we lend to the priority sectors? Tell me. What is the use of lending to these priority sectors? What are these priority sectors? See, there are many. Mainly we'll classify them under three. One is agriculture. Second is DRIs, differential rate of interest, means lower categories. Those who actually don't have money. And third is MSME. These are the backbone of any economy in the world. Okay. Do you know this MSME? We know all the big names. Reliance, Tata, then what? That Airtel, Mittal, Bharti Mittal, then what? Mahindra, all these big groups we know. But do you know how much employment is generated through MSME? MSME generates around more than 80 to 85% of the employment in India. These all big names generate only 10 to 15%. Similarly, exports. MSME caters to more than almost 50 to 60% of the exports of India, MSMEs. So that's why MSME and the role of this priority sector is very important in the development of any economy as such. No country can stabilize only on the basis of big companies. MSMEs need to be there. Okay. So post nationalization period, this priority sector lending came into existence. The following publications are statutory requirements of Reserve Bank of India. So what are statutory compulsory publications? Means RBI has to publish them. Why does RBI publish this? As a mode of governance. Governance means transparency. Okay, so RBI gives this governance part. Just now we discussed it earlier in the lecture. Governance means transparency. RBI has to give it to the world, to the common public, that how is it functioning. So which are the two reports which give the RBI's actual functioning system? Annual report of RBI and report on trend and progress of banking in India. Report on currency and finance. Annual report of the bank only. Handbook of statistics on Indian economy. So what is the answer? What is the answer over here? Annual report of the bank and report on trend and progress. Or okay, let me remove two which are unwanted. C and D removed. Now only two, A and B. Annual report of the bank and report on the trend and progress of the banking in India. Report on foreign currency and finance only. Either of these two. What do you think should be the answer over here? What do you think, guys? Yeah. Annual report, correct. It is annual report of the bank and report on trend and progress of banking in India. These two are the primary jobs of RBI. Annual report means what? It will give what RBI is functioning. How much has it? Here, main point which it will give is very important point. Has RBI able to control the inflation throughout the year? Number one. Number two, it will give, is RBI financing the government's deficit beyond the agreeable limits? Now, generally the agreeable limits are 3.5%. So, is RBI financing beyond those agreeable limits? That will come in the annual reports. And second, report on the trend and progress of banking in India, means how much the banking has progressed in India. Now, if you see the Jan Dhan accounts which were opened in 2016-17, those were a huge leap of India, right? Because of that, what happened? The Jan Dhan accounts, the banking reached to majority of the Indians. I won't say all the Indians today. Even today, many of them don't have the bank account. But the changes now, report on trend means what? Suppose if it comes to online bank account opening, that is also a part of this trend. So that becomes easier, right? Easiness is the important part while opening that account of in any bank. Okay. Everyone, again I am telling you, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, everything you will be getting. So what are you waiting for? Download it right now. Okay. The annual accounts of Reserve Bank need to be signed by the following before its transmittal to the government. What do you mean by this? See here, RBI and government are separate. RBI and government, they are separate. Okay. Government is the owner of RBI. Understand this. Government is the owner. Government owns 100% of the shares of RBI. So if somebody is the owner, what will RBI have to do? Whatever it has done for the whole year or whatever period it is, then it will have to give the report to the government that, see, I have functioned this way. Don't we give a report card in our school, college also? We get this annual report card. Same thing, RBI has to give this report card to the government. Let's see, this was my this year's profit. This was my total banking increase which I have done in the banking system. Or this is the number of branches which have opened throughout the India for the various banks. This is how the banking system has developed in India. Any report, it has to give it to the government. Now somebody has to sign on this. Of course. Otherwise, how will the government get the feeling that it's authentic? So who should sign on it? Governor, Deputy Governor, the Chief Accounting Officer. A. B. Deputy Governor in charge of monetary policy. C. Governor and Deputy Governor. D. Governor and a Chief Accounting Officer of the bank. So who has to sign it? Okay, understand one thing. Governor is definitely required because he is the head. He or she is the head. So governor is definitely required. Deputy Governor, yes, because Governor doesn't go and check each and every page. It is checked by the Deputy Governors, right? And even the Chief Accounting Officer has to sign because he has prepared this report actually. It is prepared under the leadership of this Chief Accounting Officer. Of course, there are other persons who are preparing it, but responsibility lies over here. From here, first sign will be of this guy, this Chief Accounting Officer, then second sign will be of Deputy Governor, and third sign will be of the governor. Okay, so the answer is A. And the last question for today. The following chapter of RBI Act 1934 deals with the central banking functions. So which chapter? Chapter 1, 2, 3, 4. Which deals with the RBI's with the central banking functions? Yeah. Who can tell me? Yes, it is 1, 2, 3 or 4. It is chapter number 3. This chapter deals with the functions of central bank. Functions means what central bank means why does central bank this exists? What is the role of central bank? Functions include many functions. Controlling the inflation is a prime function. Secondary functions include the forex reserves, then supervision of the banks. All these are included. Plus there are others. Banker to the government, banker to the bank, banker of the last resort, all these things. So which chapter deals with it? Chapter number 3. Okay. So now, before going, let me show you the batches. See this. Join the CAIIB Sankalp batch immediately. Okay, let me show you. See here, I would always suggest you to go through the app. In the app, what happens? How to join this? You go through the app. In the app, what happens? You get, let me show you this. In the app, you get 1% extra using the coin system. So let's go to Adda 24/7. See this. You are here now on Adda 24/7. Now look at this. On Adda 24/7, go to JIB and CIB. Click over here. Click. Now you will see the details of the batches. See this. Click on CIB November. Now look at this Sankalp batch. Starting July 21. Means today itself. So join it ASAP. All the 4 subjects are covered. Numericals, objective questions, case studies, everything is covered. How to join this? Click on this. So click. You will see the details. Look at the details. Expert faculties, interactive classes, recorded videos, product highlights are given. Recorded videos mainly. So what happens if you miss out on any class someday? You can definitely get back to it using the recorded videos. Click on buy now. See this code is already applied. July 75. Now you have one more code. July 77. 2% extra. Click on this apply. Whichever code is available, click it immediately. Maximum code. So now you are having 77% off. Click on this. You will get 23,999 reduces to 5,519. Such a huge discount. Join immediately. Okay. You can join the Mahapack as well. In Mahapack, what do you get? You get multiple batches. Look at this. JIB, CIB, Mahapack. Click on this. Click on CIB Mahapack 2. Click. Look at this. Again, go through the product details. All the product details are highlighted. Expert faculties, interactive classes, recorded videos for all the batches. Here you get multiple batches. Okay, so all the batches you will get the recorded videos. Again, click on buy now. Apply the code, maximum code 77. Then look at this. The fees reduces from 36,837 to 84,72. Huge discount. Join it ASAP because exams are near. The more you delay, the more it is a loss for you as such. So join the batch immediately. I'll be back tomorrow with another series. Till then, bye.